This is Veriscope News. Verified news, clear context. This channel focuses on facts. The goal is understanding. The tone is calm and neutral. Each report explains what happened. Each report explains why it matters. The language stays simple and direct. Today's report examines recent moves in oil markets. The focus is on prices, supply, inventories, and expectations. The information comes from a verified Reuters report. This segment provides context. It avoids speculation. It avoids opinions. Oil prices move daily. Short-term changes reflect supply and demand. Long-term trends reflect production, consumption, and policy. Crude oil remains a central input for the global economy. It affects fuel costs, it affects transport, it affects manufacturing and trade. Markets respond to inventory data. Markets respond to production disruptions. Markets also respond to geopolitical developments. Price changes do not act in isolation. They reflect a balance of forces. Some forces push prices higher. Other forces push prices lower. Understanding these forces helps explain daily price movements. It also helps explain why markets react quickly to new data. Oil prices fell during Wednesday trading. The decline followed earlier gains. Brent crude futures dropped by 79 cents. That represented a decline of 1.22%. The price reached $64.13 per barrel at 0201 Greenwich Mean Time. U.S. West Texas Intermediate crude also declined. The contract fell by 64 cents. That represented a drop of 1.06%. The price reached $59.72 per barrel. In the previous session, both contracts had risen. They closed nearly $1 per barrel higher. That increase represented about 1.5%. The earlier gain followed news from Kazakhstan. Output had been halted at two large oil fields. Those fields were Tengiz and Korolev. The halt occurred on Sunday. The cause was a power distribution issue. Kazakhstan is part of the OPEC Plus group. Strong economic data from China also supported prices in that session. That support was temporary. On Wednesday, markets shifted focus. Attention moved to U.S. crude inventories. An expected build in inventories outweighed the supply halt in Kazakhstan. 3 industry sources told Reuters that the Kazakh halt could last. The estimate ranged from 7 to 10 days. Analysts described the halt as temporary. Downward pressure from inventories was expected to persist. Oil markets have faced frequent short-term disruptions. Most disruptions resolve within days or weeks. Long-term supply depends on sustained production capacity. The Tengiz field is one of the world's largest oil fields. It plays a major role in Kazakhstan's output. Korolev is smaller but still significant. Temporary outages rarely change long-term supply trends. Markets often discount them quickly. U.S. crude inventories provide a regular signal. Weekly data shapes price expectations. Rising inventories suggest supply exceeds demand. Falling inventories suggest tighter markets. Over the past 10 years, inventory changes have driven short-term price moves. Seasonal patterns also matter. Winter demand differs from summer demand. U.S. crude stockpiles tend to rise in periods of lower refinery demand. They tend to fall when demand increases. Analysts polled by Reuters expected inventories to rise. The average estimate was an increase of about 1.7 million barrels. The period covered was the week ending January 16th. Gasoline inventories were also expected to rise. Distillate inventories were expected to fall. These expectations weighed on prices. They offset the supply halt in Kazakhstan. Oil prices affect many areas of the economy. The effects are indirect and gradual. Households. Fuel prices respond to crude prices over time. Lower crude prices can reduce gasoline costs. The change is not immediate. Household budgets feel fuel costs through transport expenses. Small price changes accumulate over months. Prices. Oil is an input for goods and services. Lower oil prices can reduce shipping costs. This can ease price pressures across supply chains. Higher inventories suggest stable supply. That stability can limit price volatility. Jobs and labor. Energy sector employment responds to sustained price trends. Short-term price moves have limited impact. Producers focus on long-term price levels. Temporary declines do not usually change hiring plans. Savings and investment. Energy prices influence inflation expectations. Stable or lower prices can support predictable planning. Investors monitor inventory data. They assess risks and returns based on supply conditions. Businesses. Transport and logistics firms monitor fuel costs. Manufacturers track energy input prices. Lower prices can improve cost control. Higher prices can increase operating expenses. In this case, the market response reflects balance. Supply disruptions exist. Inventory growth offsets those disruptions. Market participants are watching inventory data releases. The American Petroleum Institute is scheduled to release data. The release time is 4:30 p.m. Eastern Standard Time on Wednesday. That corresponds to 21:30 Greenwich Mean Time. The Energy Information Administration will release data on Thursday. The time is 12 p.m. Eastern Standard Time. That corresponds to 1700 Greenwich Mean Time. The releases were delayed by 1 day. The delay followed a U.S. federal holiday. Analysts will compare actual figures with estimates. They will assess crude, gasoline, and distillate stocks. Market participants are also monitoring geopolitical developments. Statements and actions can influence expectations. No forecasts are made here. Only indicators are noted. Oil price movements reflect competing signals. Short-term supply issues matter. Inventory trends matter more in this case. For viewers, the key point is balance. Markets weigh multiple factors at once. Price changes do not reflect a single cause. They reflect combined expectations. Understanding inventories helps explain daily headlines. Understanding supply disruptions provides context. This report presents information. It does not offer advice. Oil inventory data is collected weekly. Surveys gather estimates from analysts. The average forms the market expectation. Actual data may differ from estimates. The difference often drives price reactions. Futures markets respond quickly. They incorporate new information as it appears. This technical process explains short-term volatility. It stabilizes understanding of market behavior. This has been Veriscope News. Verified news, clear context. The focus remains on facts. The tone remains calm. Thank you for listening.